Welcome to the deep dive video update. And I want to explain this. I use deep dive in a different context than you might be aware of. I look at hundreds of charts every day, and I take the charts that are really saying something and I put those into the daily videos. Well, at the end of the week, I look through all of the charts and the charts that I didn't use all that much throughout the week, I put into this video right here. Because sometimes we can still get some insight, but we have to look a little deeper. That's how come I came up with the name Deep Dive. There are also some additional charts that are unique just to this particular video. So I just decided to create another standalone video just to supplement the other videos that I already post. This is being prepared for Monday, November 18th. Before I get into showing you the charts, I want to tell you about a thing called the SPX investing program. It's up, it's going, it's free until the end of 2024. There's a link below this video that will take you to the website or to a video to learn more about the program. You can send me an email if you want. If you have any questions, we can set up a time to talk. Also, this video that you're watching right now is the deep dive video. It's just one of the weekly videos that I do where everything is meant to tie into the daily video. Okay, the first chart that we look at, I only show in this video, and this is a chart of the VIX, but that's turned invisible. Over top of the VIX is a 50-period exponential moving average, and this gives us the range. And typically when we're going down, the VIX goes up into an higher range. When we're going up, the VIX goes into a lower range. This was after the COVID plunge and then the difficult year in 2022. Well, we're going down. Now, we started to go back up with the VIX, and we were getting very high readings before the election. And then the VIX really started to come down. Well, now it's starting to go back up again as the market's been a bit under pressure. So we have been going up, and that's a little bit of a concern, but we're not out of the range that we've been in lately. If we are able to turn back more positive, the VIX will probably continue to decline. I was showing this for a few days when we were really screaming to the upside and the VIX was dropping very fast. I plot a momentum oscillator on here called the RSI based on 9 periods, so it's shorter term. And we look for extreme positive or negative readings. Well, when the VIX was really dropping as the market was going up, we were getting very low readings relative to where we had been with the VIX. And so that kind of showed us maybe the VIX has gone down too far too fast. And that proved to be true. Well, now the VIX is going back up as the market's a bit under pressure right now, but we're more neutral. I really only show this chart in the daily videos when we're extreme positive or negative. And then this is another variation of the VIX where the VIX is calculated using at the money options. This thing called the skew index is calculated using out of the money options. And we were getting pretty high readings leading up to the election. The market was expecting some kind of a move. Now, this doesn't tell us if it's going to be an up move or a down move, that some big move should happen. Well, we're getting kind of high readings now, but we're not up into this red area. I only show this in the daily videos when we go up into the red area, and that just means the market is expecting something. Then another variation of the VIX is to do a correlation between the VIX and the S&P 500. Also, about the time we were getting really high readings with the skew index, we were also getting really high readings with this, and we were getting really high readings with the VIX. And that means the market was pretty nervous, especially leading up to the election. And then since that time, we were really going up, and this ratio has really gone down as stocks had been going up and the VIX was going down. That's what drops this correlation here. We'll have to see if it's going to turn and go back up if we see more pressure with the S&P 500. We look at the VIX and then take a ratio of a thing called the VVIX, or the volatility of the VIX. Some people call it the VIX of the VIX. And we can get some general ideas from this. Typically, when this is going down, that means the VIX is going down as the S&P is going up. And we saw that. Well, then we hit another period of time where this ratio was going down and the VIX was going down, and we were chopping along, but we were still going up for the most part. Now, we had been going up with this, but lately this has been rolling over. We'll have to see. Is that going to continue to go down? That would typically be more negative. If it turns and starts to go back up, that could be negative for stocks, but if it continues to go down, that's typically more positive. All right, then we look at a ratio between the volatility of stocks, the VIX, and the volatility of bonds, the MOVE index. And that's picking up a little bit, but what I tend to follow the most is the red moving average. And overall, that just means that stocks are slowing down in their volatility relative to bonds. And you have to excuse my voice. I'm dealing with a head cold here, and it kind of messes me up here. Now, sometimes I really show this chart a lot. It's an attempt at looking risk on versus risk off and taking a ratio in the market itself. Well, we're not really moving all that much. And what we're looking for are big moves either up where we go more risk on. That's when the market's more really strong and really moving to the upside, which we've been doing that. But this just means that we haven't been moving all that much. It's not just a small group of stocks that have been leading the indexes higher. We're seeing more participation across the market as measured by the equal weight index. And when that happens, this ratio pretty much just kind of goes sideways the way it has been. And I watch this every day to see if we're really breaking up to the upside or breaking down to the downside. But in the meantime, it really hasn't given us any additional insight. So I'll just keep watching this and I'll break it out and use it in the daily video when it's needed. We also look at a ratio between large caps and small caps. And when this is going up, that means large caps are outperforming small caps, which really saw some upward thrust right after the election. Now have been starting to give those gains back. And so we're seeing the large caps actually coming back up, but we're not really breaking. We're not really seeing much of a trend for most of 2024 here. We saw a nice little upward thrust earlier in the year, but that just was kind of a false breakout. So I'll keep an eye on this, and if it does start to really move in one direction or the other, we'll watch that. And then I made some adjustments to this. If you've watched these videos before, with this chart, I used to just say, okay, we're 21.83% above the previous high set in January 2022. Well, I decided to put some other things in here. The October 2022 low, that's really when we bottomed here, and things were looking pretty bleak at this point. And I was saying, I think we bottomed. I think we bottomed. People were sending me emails and comments saying, no, you're nuts. We're just getting going. The perma bears were partying like crazy. Well, we did end up bottoming here. And if you go back, if you started to go long about this time, look at the amazing return that you would have had. Now, it wouldn't have felt like the right thing to do right here, but it would have been the right thing to do. But you have to wait for evidence to actually suggest, okay, we're actually in a bottom. Because you could have said, oh, we're at a bottom here, or we're at a bottom here. It looked like we could break to the downside, but the smart money really started to come back in. This was the bottom, and we're up almost 68% since the October 2022 low. Now, that's an intraday low. And then a year ago, we also had a low in October of 2023, and we're up for over 43% as of Friday's close. Then stockcharts.com has this thing called technical alerts. I go through them in every daily video each day independently. These are the alerts for the whole week. And you can see a lot of blue or green, depending on what color you see, that tends to be a positive day. An awful lot of red, that's a negative day. So I actually look at them as they're being generated during the week and sometimes even discuss them in the video. But this just gives you a color type of confirmation. Yeah, we're having some problems here. Or we're really going up, as we saw earlier on in the week. And then stockcharts.com has another tool where they take either a stock or a sector or an index and they try to remove all emotion by giving it a score on a scale of 0 to 100. The higher the score, the better looking that chart from a technical analysis perspective. Because technical analysis was really created to try to remove the emotion. Unfortunately, it doesn't do that. You can have 10 different people looking at the same chart and reach 10 different conclusions. And some are seeing positive things, some are seeing negative things. So that's why I look at these. It's definitely, it may not always be correct, but at least there's no emotion going into this. And there are 5 indexes. Believe it or not, right now, the Dow, which had been not doing so well, even though it was creating all-time highs not too long ago, It's holding up the best currently, coming in at 79.6. Now, when the indexers are really strong, they're going to be into the high 80s and low 90s. We're underneath 80 right now with the best looking index as the market has been under some pressure. Coming in second place, close second, 79.5 with the SPY. There are 503 stocks that make up the S&P. So when we looked exhausted earlier this week. It's like we just kind of fizzled out and we just kind of really didn't do too much. And then things turned more negative. And we saw those things developing in the daily videos. And that really dragged the overall score down here. But this is actually holding up a little bit better with the S&P at 79.5. Then we have the small caps, which really had been doing well. Well, they gave a lot of that back. We're down 4% on the week and coming in with a score of 77. Then we have the QQQs, which a week ago they were in first place. Well, they dropped down here to 69.9. And then we have the mid caps, which earlier in the year, they were the better performing index for many weeks at a time. They would come in number one. Now they're not looking so good, coming in at 66.1. All right, then I have a short-term rainbow. I sometimes will show this in the what to watch video because I like to, even though this is short term, I like to get a bigger, longer term perspective with this, kind of see the whole chart at one time. And we're pulling back in the short term, but we're still above the 20 period moving averages. That's what I use to determine if we're positive or negative in the short term. Well, I also have a 10 period moving average on here too, and other moving averages going up to 50 periods. And yeah, we're coming down, but the lines are still going up for right now. So there's not an awful lot of damage that was done to the short-term trend based on moving averages. And then we have some studies that we look at. And one of the areas that I've been following lately are the number of stocks in the S&P above their 20 period moving average. Well, and this is going up when we get above 70. That means the short-term trend is really strong. And we never did get up there, even with the breakout after the election. But now we've been coming back down a little bit. I really only focus on this chart when we get above 70 or if we have a real negative time and we drop down below 10. So that's why I haven't been showing it in the videos. Then another rainbow going from 50 periods up to 100 periods, coming down, but we're not even at the rainbow yet. We're still well above the 50 period moving average. So after Friday, the conclusion that I've reached so far in the daily video is that we're just pulling back. Now, we want to keep an eye on things. We don't just assume that. That's just what we're seeing for right now. Things could turn more negative. I follow a couple of perma bears mainly just for entertainment purposes. And oh boy, they every couple of weeks, about every other week, they declare the end of the stock market and the crash is just around the corner that never seems to come. Oh, they're out there tooting their horns right now, too. But according to this, we're still holding up in the intermediate term. Now, if we see more weakness, of course, that will change things. But to just say things are going to fall apart when everything is still looking quite positive, to me, that's foolishness. All right, then I was showing this in the videos for a while. This is the CMB Composite, which is supposed to be a standalone trading system. I don't use it like that. I don't think it's all that effective. I have found that the oscillator can be helpful. And when we get an extreme reading like we were, then I start showing it in the videos. And this just shows that maybe we've gone up too far too fast. Well, as we've been dropping back down now, this indicator's also been coming down. And so it's in neutral land as far as I'm concerned. And I will not really show this in the video unless we get another extreme positive reading or continue to fall and get an extreme negative reading. And then I was showing this. The percent B indicator, it measures when we're outside of the upper Bollinger Band when we're going up and the lower Bollinger Band when we're going down. And what was interesting is that right after the election, the week after, through that Friday where things were looking really solid, we were getting an extreme reading here on the daily chart. We were also getting an extreme reading on the weekly chart, and we don't see those very often. And when we do see signals like that, you can see other times they tend to not stay extreme for very long. We'll either see the market go sideways, the Bollinger Band will continue to go up, price can go down, or some combination thereof, which will bring it down. And that's what we've been seeing as the S&P's been under pressure. And then because we're not even at the 20 period moving averages yet, I haven't been showing the 50 period moving averages. These are still looking solid, but if we continue to drop, I will be starting to show this chart in the videos. And the same thing with the 100. I use the 20 for short term, the 50 for intermediate term. This is like intermediate term slash long term. And then the 200-day moving average, that to me is where the real long-term evaluation comes from. And as long as we're well above these lines and the lines are still going up, there's been no need to show this chart. And then I have a thing called the boom indicator, which measures how far away are we from the 20, 50, and 200-day moving averages. Because if we get too far away, the moving average acts like a magnet and it'll pull price back to it. And that's where I get the name boom, because it's like you go too far away, boom. It's like a dog on a leash. You'll let the leash go out and they get too far away. You start pulling them back closer to you. And that's what this is attempting to measure here. And we were getting kind of far away from the 20 and the 50. Well, since that time, as we've been coming back down, we use these indicators down below like an oscillator. And we had worn off being extreme positive, both with the 20 and the 50. And then this is the Ichimoku cloud. And this can be helpful sometimes when we're declining and we're above the cloud. This whole green area could provide some area of support. It's not all that defined, but there's a lot of people that use this, especially that trade Forex. What can also be helpful are the full studies that are applied to this, and they're basically trend based. We have a blue line and a red line, which are pretty much on top of each other right now. If the blue line drops below the red line, that's going to turn things more negative. And then the green line, it's been going up. It's starting to roll over as well. So yeah, this chart is looking vulnerable, but it hasn't really turned over completely negative yet. And the mass index, it only generates a signal if we're up around the red dashed line and the blue line, and we're far away from that. And the Pring bottom fisher, it's just continuing to decline, and it really is not generating anything right now. Now, I do talk about this in every daily video. I go through the 19-day advanced decline ratio. Well, this chart breaks it out because usually when I'm talking about it in the daily video, I'm talking about price. This also includes volume, and we're dropping below zero, both based on price and volume. So that's turning the short term a little bit more negative. So we'll keep an eye on that and see if that's going to eventually bleed through and have more of an impact on price now that volume is also turning negative. And then we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows. We're still above zero. Now, if we drop below zero, that's going to turn things negative in the longer term, but we're still hanging out above that level for right now. And then we take a 10-day average of the highs and the lows for the S&P. And when we were really going up, and for a lot of 2024, we've been just pegged near the top here, above the green line. And that shows good, solid, longer-term momentum. Well, we've been dropping down now. So we'll have to see at some point, are we going to turn and go back up, or are we going to continue to fall? This is still positive since it's above 50, but the context is that this is declining and we're a little bit concerned about that. And then we want to measure how far away are we from the 200-day simple moving average. We really came down this past week and we're 8.4%. What was that? 8.49% above the 200-day moving average. And this just measures, this is kind of another attempt from the October lows up to where we're at now. This is coming in at about 30. I would trust the previous chart that gives you the numbers because I actually use a spreadsheet to calculate those, where I just kind of have to eyeball this and you move this a teeny tiny little bit and the percentage change can really turn a lot. Another thing that I keep an eye on with this chart is when we're hitting a high, like we saw over the summer, and then we really start to decline, and this was the doomsday day on August 5th, we were getting close to a 10% decline here. And it was right at about this point when the smart money started to come in and buy, because the definition of a correction is a 10% or more decline from an all-time high. And at this time, that was an all-time high, and we were really going down after that. So I just keep this on here and I look at this and I'll adjust this on an as-needed basis. I also use the Connor's RSI just like other oscillators, looking for extreme positive or negative readings. Even though we're getting a low reading now, it's not extreme. And then I did add this other little short anchored moving average. Typically moving averages, well, actually the moving averages that we use the most, they look backwards. They use past data. Anchored moving averages try to project things forward. And usually here, when we're going up, we mark these at other lows. Well, we've broken below this short-term anchored moving average here. Well, I don't know if I'd put much importance on that. If we really start to come down and hit this orange and especially this blue anchored moving average, you can see how this did provide support at other times. And if we break below that, that could turn things more negative. Then we want to keep an eye on the S&P 100, which are the biggest stocks that make up the S&P 500, and they're pretty much moving in tandem with each other now. We didn't see enough of a move to generate any X's or O's. We're still working off of a triple top breakout that was generated on November 16th. And we see lots more X's here. We see blue trend lines going up. This chart is still looking positive for the time being. Then a long-term rainbow here going from 50 periods up to 250 periods. Yeah, we're coming down, but the lines are still going up. So the long-term trend is still intact. And the daily chart of the special K, we finally are seeing a cross on the weekly chart. And it took over a year for that to happen, where we've been positive for over a year here on the daily chart. So we're seeing a little bit more confirmation, both in the shorter term and the longer term, with a long-term oscillator here. And then on top is a weekly chart of the S&P, and then in the middle is a weekly chart of the German DAX. And we're seeing a pretty strong correlation. And in Europe's kind of trying to figure out what to think of this whole Trump Republican victory thing, because it's not necessarily the direction that they've been headed. They're heading more towards the World Economic Forum and, these borderless countries and the whole EU concept and all of that. And so they've been kind of mixed up. There are some days when we see things really strong in Europe and other days when it's pretty weak. But right now, there's a pretty strong correlated relationship longer term on a weekly chart between what's happening in Germany, which is the biggest stock market in the EU, and the S&P 500. And then different support and resistance levels. One of the charts that I usually show here, I'm actually using in the daily video now, but these are I call it possible fib retracements because every time we hit a new all-time high, I have to readjust this. But going back to the high that was set earlier this week on Monday, and we're starting to come down, but we're still way, way above this 38.2% retracement level. So unless we really start to scream down, there's been no need to show this chart. All right, then looking at the Vixen, gotta love that name. The VIX measures the volatility of the S&P 500. The Vixen measures the volatility of the NASDAQ 100. And it had been really going up as well. And then it really dropped down. And now it's starting to go back up again as the NASDAQ 100 has been under pressure. And then we look at the S&P, and then we try to take a ratio here of tech stocks, QQQ, that's the NASDAQ 100, and the best of the best stocks. These are the diamonds or the Dow Jones Industrial Average, and then see what is the correlation between the two. And it's not strong right now. The ratio between the S&P and this other ratio here, so it's a ratio of a ratio, the correlation is not all that strong right now. It's really more neutral as the market's trying to figure out what it's going to do. Look at the bank ETF, and I watch the financial sector all the time because we're looking for any signs of problems. But no, the financial sector is doing really well. And the bank ETF is holding up quite well, just coming off of recent all-time highs and in an uptrend. And then we want to keep an eye on the smaller banks, like a year and a half ago was Silicon Valley Bank, Republic Bank, and then about a year ago was New York Community Bank. That's what really sent this ratio going down. It's holding up for right now. It just means the regional banks are actually in an uptrend compared to the financial sector. Not breaking to the upside, but it's not falling apart now either. And some rate of change charts, I just use these for information. These are very long terms. I usually top out at the 200-day measurements. Well, this is 250, and this takes Friday's close and goes back 250 trading days and says, okay, what's the rate of change? How have we changed in that time? And we've been coming down a little bit after we had been really going up. And this is that same thing. We're coming down and we're above this blue line, but we're starting to come down to that blue line now as we're seeing some weakness in the market. Then we keep an eye on bonds, and we're still trying to figure out the context of this. Now, if you project this back to 2022 and this ratio was going up, when you look at 1 to 3 month T-bills, that's cash. and compare it with 3 to 7 year bonds. When this ratio is going up the way it is here, that means there's uncertainty about interest rates and it's risk off and they're worried about inflation. Well, we were coming back down here and things were looking a little bit better, but now we've been going back up. We started to turn back up once we got through September and into October. This is still going higher. Does that mean the market is getting worried about inflation again? There is some talk out there because a lot of the economic reports that have been coming out lately have been stronger than expected. And Trump is a businessman, and they like the fact that he's going to probably try to keep the tax cuts in place. They would have expired otherwise. And he's going to try to get rid of a lot of regulation, and he's trying to get rid of a lot of waste in the government. Stock market likes that. That could produce a real growth type of an environment. Well, when you have growth, you often have inflation. And it's the balance between the two, whether it's, all right, we can still have inflation as long as we're still growing. It's when we have inflation and we're not growing, that's stagflation. Or when we're in a really high inflationary environment, like what we were seeing back in 2022, and then a couple of times looking here back in 2023, it's the market trying to front run what they think is actually going to happen economically. And this is a little bit of a concern to us that this is going up and we're trying to figure out the context. But when you look at the next chart, this is TIPS. These are Treasury inflation protected securities, and then a ratio of 3 to 7 year bonds. Back here, we also are comparing cash to 3 to 7 year bonds. You see how this ratio is going up. This ratio has actually been coming down. So it's like, okay, there's not a lot of confirmation across the market. Because again, when this is going up, there's worries about inflation. There's worries about interest rates going up. Now, this had been going back up because interest rates were going up, but not necessarily inflation, but interest rates were. But now this has been coming down as the previous chart's been going up. So we're going to have to see how the market works this out. And then we look at the long-term bond ETF, that's in blue, compare it with the S&P, which is in red. The longer term correlation is kind of weakening. It's not real strong. And even the shorter term correlation is weakening at this time. And we look at the same thing with the Qs to the long-term bond ETF, except instead of blue, now here it's red. Also, a tendency to be going in opposite directions right now when we look at the correlation. Then we look at the 10-year yield in the US and subtract the German 10-year yield. And you'd think, who in the world ever thought this one up? Well, somebody did. And then I thought, this is kind of interesting. And this gives us a line. And then we plot the US dollar index, which has been really strong lately. And believe it or not, there's a pretty high correlation between interest rates in the US and in Europe and the dollar. And they're all going up at the same time right now. And that's pretty solid correlation. Now, is it the concern that interest rates are going up because we're worried about inflation? Well, inflation doesn't seem to be a problem right now. The market may be trying to front run this because they think there's going to be economic growth and they want to get ahead of inflation. And the dollar's been going up because the market really liked that the election didn't fall apart, that Trump won both in the Electoral College and the popular vote, and the concerns over the election system seem, at least for right now, seem to have gone away because there wasn't a lot of confidence. People weren't really sure that things were being run the right way there. And then so when a country is seen as stronger and more robust, their currency tends to go up in value. Now, we're still in a downtrend with the dollar currently, but shorter term, it's really been going up against the euro, against the British pound, and against the Japanese yen, as we're seeing interest rates going up too. And as I said, there's a pretty strong correlated relationship on this chart. And then we keep an eye on the 2 year yield. That's shorter term, where it had been dropping, but now it's starting to go back up. Typically, when we spike up and go down, that'll provide some kind of support to the S&P. It really hasn't been playing that big of a role, so I haven't been showing this chart. Then we look at the 10 to the 2 yield curve, which is no longer inverted, or we say uninverted. It finally went back over. We still have the 10 to the 3 month, which is inverted, but it's getting close. It could go back and get uninverted here about any time. And then this has been a concern too. we compare or European stocks, the Eurozone ETF, with American bonds based on interest rates or price here. And you can see that the Eurozone is really underperforming and we're dropping down below the rainbow. And so that's a little bit of a concern. We would like to see when the market's more strong, stocks even in Europe outperforming bonds. That's not what they're doing right now. So this is a little bit of a warning sign to us that we'll keep an eye on things. Then I have some things called possible positive scenarios. And these are just a series of studies that I do with the percent of stocks above their 200-day simple moving average. I use this like an oscillator. We're not extreme positive or negative right now, so I haven't been showing this. And we also, those stocks above their 50-day moving average in the S&P, using it like an oscillator. And then we look at the mid caps, also using it like an oscillator, as well as the small caps. And we're not getting any extreme readings from this chart, so there's been no need to show them. So thank you. I hope you found this helpful. I really hope you're having a great weekend, and I will talk to you in the next video.